Securities. You never hold back. You tell us what you think always. And right now, you are saying it's Nvidia, everybody. Don't get fooled thinking Google's the AI leader. Why not?
Look, I mean, look, Google's obviously, one of our favorite names as well. But my whole point is demand and supply is 12 to 1 for NVIDIA chips. Meta can't get enough of these NVIDIA chips. There's 30, 40% they can maybe get. Where's the rest coming from? You look at what Google's doing on TPU, you look at what ultimately AMD is doing. There's others that are going to benefit. But at the end of the day, it's NVIDIA's world. Everyone else is paying rent when it comes to the AI revolution.
So at this point now, when we hear that Google's making a deal possibly with Meta and NATO and all these other things, you don't think that it needs to be Google that will be the leader? I mean, there's a lot of things that are going on.
Yeah, I mean, because Nicole, look, these come back from Asia, being there 3 weeks. I mean, NVIDIA, most of these are basically sold out through 26 when it comes to chips. So when you look at, for smaller capacity areas, training, and some of the other sort of use cases, you could use Google chips. But just like you're going to be able to use, you look at big tech companies, they're going to ultimately build their own chips over the coming years. But the reality is that this AI revolution, it's being built on one chip, and that's NVIDIA. And I think doubting that, I think it's just the wrong move.
Right.
This continues to be, one godfather of AI, that's Jensen.
All right. You also, when you talked about him being the Rocky Balboa of the AI revolution, I also heard that you said the likelihood of no cut was the same from the Fed was the same as you being the center for the next year. Even when we had the unlikely situation where maybe we wouldn't get the cut, you thought the cut was coming. Why is the cut coming? And are there more cuts coming?
Yeah, I mean, look, me and Tuckman have talked about this a lot, right? The reality is that, like I said, like there's a better chance of me playing in the NFL this weekend or the NBA than ultimately a cut not happening. But I think it just shows. Look, the reality is you're going into a dovish cycle. In terms of Hassett, ultimately that's going to be Fed next Fed chair. That is bullish, and I think just going through the sort of knee jerk and doubting, I think the narrative that we're in, I think that's how you lose money. I mean, the 10 years telling you something, and I think it just speaks to what I view is going to be a risk on, not just into year end, but as we go into 2026. That's what I told Einstein, get the S&P 7,000 hats ready for the coming weeks.
He has them. So when we think about the names, that have the potential, for AI, the biggest name is?
Well, the biggest name is obviously NVIDIA, but I think when you look at Microsoft, that continues to be the table pounder relative to what's happening on the enterprise. I mean, I think Microsoft, Meta, and Oracle, those sell-offs make those all table pounder names to own.
Right, because I was going to ask you about cloud services, and then cybersecurity. So your winners in each one are?
Yeah. So I think if you look on the software side, the massive AI Palantir, I think that's $1 trillion market cap next 2 to 3 years. That continues to be one of our core winners, along with Snowflake, MongoDB. I think on the infrastructure side, Nebius, I think that continues to be very, I think underappreciated in terms of everything they're doing. And then I look on cybersecurity, everything George is doing at CrowdStrike and what Nikesh is doing at Palo Alto, those two names stick out front and center. And then, of course, it's the hyperscalers that we continue to own. And look, it speaks to the Ives AI 30. Who are the winners? Who are the second, third derivatives? The bears will come out of hibernation mode and they'll scare. I get it. It's just part of this market. The reality is this tech bull market has another 2 years, and that continues to be our view in this AI revolution.
Everybody everybody wants to see the revenue generated. They're getting tired of all the spend, and while many say, look, I don't think we're in an AI bubble, we want to know when we're going to start to see some revenue generated from all the spending that's happening. And by the way, that's what's driving the economy, and it's not slowing down, because if it slows down, then we lose, right? So they have to keep spending. These hyperscalers, and a lot of circular spending. But when do we start to see some revenue generated? Is that soon?
Well, I think 26 is going to be the year of monetization. But also look at Palantir. You've seen it. You've seen it in Snowflake, MongoDB. I mean, the point is, like, but 26 is where you're really going to start to see it on the enterprise side. Consumer hasn't even started. That's late 26, 27. But Nicole, it's my view, like, this is building Vegas from the desert in 1950s. It's building Dubai, first shovels down 25 years ago. I mean, that's how you have to think about this build out of a fourth industrial revolution. And I think it's short-sighted when investors are like, well, I'd rather them just, increase revenues, increase EPS, increase free cash flow, maybe like a Meta into next year. No, you want to see Zuckerberg being wartime CEO, spending in the AI arms race, monetizing the future of Meta.
So I know that you talked about, for Meta, the consumer monetization, and you actually think it's way oversold right now, right?
Look, I just think it comes down to, like, Meta is not going to second, third, fourth choices when it comes to chips if they didn't think the opportunity was there. That's why Zuckerberg's doing this. And also, you have 3 billion users you're now going to monetize on the consumer side. And I think, look, it goes back to, like, this is an arms race. These are real use cases. This is not a bubble. This is the beginning of a fourth industrial revolution. We've said the AI party started at 9 p.m. It's now 10:30 p.m. Party goes to 4 a.m. I'm not saying in parts of the party, DJ doesn't stop playing music, glass isn't on the dance floor, maybe cops come to the party because of loud music. Party goes on till 4 a.m. The bears will watch that party from the outside through the windows.
Because of the advantages the technology offers, Meta, Amazon, and Alphabet are using AI into their business processes. These businesses all use Nvidia's CPUs to run inference apps and train AI models. It is simple to understand why experts anticipate Nvidia's stock performance and growth to continue to be exceptional. For tech companies, the most recent earnings season was fantastic, with many reaping the benefits of their investments in artificial intelligence, AI technology. Naturally, investors have questioned the possible returns on their investments, raising doubts about whether the enormous sums of money large tech companies are investing in AI are warranted. It should come as no surprise that despite their strong performance, large tech stocks have been under pressure this earnings season. Nonetheless, the most recent findings from semiconductor giant Nvidia unequivocally show that IT firms are still investing in AI infrastructure. Let's examine the reasons for this and determine how to profit from the significant investments that big tech is making in artificial intelligence. AI may assist increase production and efficiency, decrease redundancy, and improve returns on investment, which is a major reason why governments and businesses invest in it. According to market research firm IDC, for instance, every dollar invested in AI services should yield $4.06 in value. Tech behemoths like Amazon, Alphabet, Meta Platforms, and others have cited measurable benefits from AI. For example, Meta Platforms reports increased user interaction on all of their social media channels. Users are encouraged to spend more time on these platforms by the AI-recommended material on its websites, which increases its ad revenue. In a similar vein, Amazon's usage of AI-powered robots in warehouses not only increases productivity and decreases monotonous chores, but also improves worker safety. In the meantime, Alphabet recently noted that its cloud services, large language models, LLMs, and AI-powered search features all saw strong growth. Therefore, it is not unexpected that all of these businesses have committed to increasing their capital expenditures in order to develop further AI data center features and infrastructure. One estimate suggests that this year's big IT capital expenditure investment could increase by 62% to $405 billion. Since many businesses are looking to increase their investments in order to swiftly construct additional AI infrastructure, that amount is probably going to rise in 2026. You might now be asking which business will benefit the most from its significant investment in AI. Who will it be? Amazon, Alphabet, Meta, or another company? You won't be shocked by the response. As I mentioned before, Nvidia's performance has shown us that large tech companies are likely to continue investing heavily in AI technology. I mentioned it because Nvidia offers essential technology that contributes to the realization of AI. This is due to the fact that every major tech company included in this article depends on AI models to produce different features. While Alphabet's Gemini LLM is seeing high client demand, Amazon, for instance, is utilizing AI algorithms to power its warehouse robots. In the meantime, Meta is concentrating on creating the upcoming generation of AI models. These AI models and inference applications are powered by Nvidia's processors. The company has a significant lead in the AI chip market, which accounts for its steady growth each quarter. In the third quarter of fiscal 2026, its revenue jumped 62% year-over-year to a record $57 billion, primarily due to a 66% increase in data center revenue to $51.2 billion. Furthermore, the business notes that it has sold out of its graphics processing units, GPUs, which are needed for AI model training and inferencing due to high demand. During the results call, Nvidia management admitted that it had received orders totaling $500 billion for 2025 and 2026, of which about $150 billion had already been completed. The company is working hard to acquire more components so that it can construct more GPUs to meet the massive order backlog, since CFO Colette Kress is optimistic about getting more orders. Nvidia's revenue projections have increased dramatically, which is not surprising. Even better, the company's earnings growth rate is predicted to pick up a few points in the upcoming fiscal year, reaching 58%. In fiscal 2027, starting in January 2026, the bottom line is predicted to reach $7.42 per share. Nvidia's stock price might reach $238 if it trades at 33 times earnings at that point, which is consistent with the earnings multiple of the tech-heavy NASDAQ 100 index. That suggests a possible 33% increase from current levels, but don't be shocked if the company makes larger gains, because its backlog will enable it to produce a sharper boost in earnings. Considering the potential upside, purchasing Nvidia's AI stock seems like a no-brainer, especially since the company is currently selling at an appealing 23 times forward earnings. The market for AI chips is still dominated by Nvidia today, and many consumers will probably still favor its goods. The Meta-Alphabet discussions, nevertheless, draw attention to the dangers of big purchasers switching from Nvidia's solutions as soon as competitive alternatives satisfy their performance and price requirements. Nvidia's portion of the next wave of AI infrastructure spending might be significantly reduced if Meta eventually commits billions of dollars to TPUs for new data centers while still using Nvidia GPUs elsewhere. This could also weaken Nvidia's pricing power. Nvidia's stock is still valued for sustained supremacy despite the recent decline. At the moment, the stock's price-to-earnings ratio is 42. If Nvidia can sustain exceptional margins and quick sales growth as AI spending rises, that could be justified. However, if substitutes for its products start to gain traction, the company's expansion may stall while profits are squeezed. Naturally, the headlines about Meta-Alphabet don't indicate that Nvidia's moat is getting smaller. It's too soon to tell. However, the headlines do highlight a significant risk. Nvidia is mostly dependent on a select few cloud and AI leaders who are increasing their investments in alternative and internal silicon in an effort to lower costs and lessen their reliance on a single source. Nvidia might experience slower growth and more pricing pressure later in the decade than current valuations indicate if such initiatives are successful. This makes this sell-off challenging for investors. The stock still carries enormous expectations at a time when Nvidia's biggest clients are looking into reliable competition, despite the fact that the underlying company is still incredibly robust. Considering that combination, it may seem premature rather than wise to take this downturn as an automatic buy-the-dip moment. In the meantime, the Financial Times reported on Thursday that top Chinese companies are training their AI models overseas in order to obtain Nvidia's processors and evade U.S. policies intended to impede their advancement in cutting-edge technology. According to the report, which cited two persons with direct knowledge of the situation. Alibaba and ByteDance are two of the tech companies training their most recent huge language models at data centers in Southeast Asia. Following rumors that Meta would use Google's tensor processing units, Nvidia denied concerns that its edge in AI was eroding. Nvidia stated in a post on X that its GPUs are still a generation ahead of the competition and that the platform supports all AI models wherever computation is done. In contrast to more constrained ASIC-style designs like TPUs, the business emphasized the versatility and wide range of applications of their Blackwell chips. Google employs TPUs internally and makes capacity available through Google Cloud. It does not sell them directly. Customers are being encouraged to consider alternatives to GPU-heavy stacks by the positive reviews given to Google's most recent model, Gemini 3, which was trained on TPUs. The existence of what he called scaling laws, that is, the more chips one makes and the more data one steps through to build models, was even mentioned by NVIDIA CEO Jensen Huang. This raises the possibility that the need for computing may be growing. For investors, this means that although competition is intensifying, both GPUs and TPUs may be able to gain more business as AI loads increase. Reuters was unable to confirm the report right away. Regarding the report, NVIDIA declined to comment. The article claims that since the United States decided to limit sales of the H20 chip in April, training has steadily increased in offshore locales. According to the publication, Chinese businesses rely on lease agreements for foreign data centers that are owned and run by non-Chinese enterprises. However, DeepSeek, which amassed a sizable stock of NVIDIA chips prior to U.S. export restrictions, was an exception because its model was trained domestically. In order to optimize and produce the next generation of Chinese AI processors, DeepSeek is also working with domestic chip manufacturers, including Huawei. Don't forget to share your thoughts and experiences in the comments below. Your input helps create a more knowledgeable community where we can all learn and grow together in the world of investing. Stay up to date with the latest market trends, insights, and key updates by subscribing to Investing Tutorial. We're here to help you make smarter investment decisions and stay ahead of the curve.